Hi everyone. We all know in the stock market, high risk comes with high returns and vice versa. Blue chips give steady return and attractive dividend, but the returns are not as good as growth stocks when they burst out. Today, I'm going to show you the way to make much better profit from blue chip stocks. This strategy involves options selling. You may have already known the fact that selling options give more profits than buying options. It's easy to understand. The risk is controllable to the option buyer. The most you will lose is the premium or the money you use to buy the option. The risk is huge to the option seller because theoretically the loss can be infinite. Like most of the popular stuff in the world, the need is more than the product. The option seller therefore has the advantage. The safest way of option selling is covered call. Covered call option requires you to have at least 100 shares of a certain stock and then sell the call option of that stock. The call option strike price is going to be higher than the current stock price. Your prediction or your hope is before the option expires, the stock price won't reach the strike price. The advantage of this strategy is if your hope is true, you will get the premium you collect from selling the option. The disadvantage is if the stock price goes above the strike price, no matter how high it goes, it has nothing to do with you. Selling covered call won't get you to lose money, but you will sacrifice the potential increase this stock has till the expiration date, in exchange of premium you collect immediately from selling the covered call. I'll give you a real-life example on one of my favorite stocks, Disney. I've talked about this stock in previous video. In the long run, the stock will head up. My observation is most of the time, its stock price won't go above 5% in a week. Therefore, I'll sell a covered call option expiring in a week with a strike price 2 to 5% higher than the current stock price. I will perform this strategy almost every week. Here is the price graph for the last 5 years. Let's say I bought this stock at $100 5 years ago and luckily sold it at $150 before February crash. My yield plus the dividend is going to be about 60%. A 12% annual return, not too bad, but I wouldn't call it attractive. However, with the option strategy, my 6 months return rate is an additional 12%. How does 36% of annual return sound when talking about a safe dividend stock, also blue chip, right? So I'll show you what I did. For example, on April 13th, my prediction is the stock price in the following week won't rocket, so I sold one covered call, expiring in 1 week, April 20th, with a strike price of $109. I made $200 premium. In the following week, the stock price never reached $109, so I made $180, considering the option fee. It's about 2% of my total investment on Disney this week. Since I'm holding the stock in the long run, I don't care this week it goes up or down 5%, but the premium is cash in hand. If you keep doing it, that gives you good returns. Unless there is huge uncertainties, like new COVID spreading, election, I'm performing this strategy every week. 2% is not huge return, but when it occurs weekly or even monthly, that can be very attractive. This covered call strategy is like you buy a house and then collecting rent. If it's a good house, you don't want to sell it. However, you would like to collect some money from it every year, every month, or even every week. However, like in real life, my rental property may have leak sometimes, which will cost you money. Just like in the stock market, my prediction won't be right all the time. On April 27th, my prediction is the stock price is going into adjustment, so it won't shoot up. Therefore, I sold one covered call expiring 10 days on May 8th with strike price of $109. I made $230 premium. But this time the stock didn't go above 109. It reached 110 the next day. I can choose doing nothing and let the option buyer took my stock at the strike price. But since I still believe in the potential of Disney, I didn't want to do that. Instead, I purchased the option back at $245. This time, I lost about $35, including the option fee. Like I said, my prediction isn't going to be right every single time. I can't get 2% every week. But in the last 6 months, the covered call option selling has given me an extra 12% return. Smart investors may have observed that this strategy is only good for stocks with relatively stable price, like Disney or McDonald's, etc. If you try to use this on Tesla, every time this stock shoot up fast will cause you to lose huge amount of profit. Another reason I chose Disney is because I like its future. It will continue going up in the long run. But there are a lot of other stocks out there with similar properties. I'm pretty sure you have your eyes on your own Disney. Lots of active investors are trying to predict how the market will go in the future. Most of the time, this prediction, even correct, doesn't turn into real profit for them. In that case, why don't you use the covered call strategy? This way, your prediction is actually worth something, not just amusing yourself. Okay? That's it for today. If you find my video helpful, please click that ravishing like button and subscribe to the channel. Thank you very much.